Welcome to the Stock Market Palantir. Today we are going to talk about BLMZ.
Welcome to the debate. Our focus today is Harrison Global Holdings, Inc., trading under the ticker BLMZ. This is a company that executed one of the most radical strategic pivots we've seen in the microcap space in late 2025. It went from a failed Japanese audio firm, BLMZ, Inc., to a diversified holding company with really aggressive exposure to crypto.
And that transformation was incredibly rapid. It involved some pretty significant financial engineering. We saw that critical 1-for-10 reverse stock split, and then this sudden implementation of a Bitcoin treasury strategy. The market is it's deeply polarized, trying to figure out what all these moving parts really mean.
All of it. Is it a legitimate, high-risk, high-reward play to unlock new value and maybe even trigger a short squeeze? That's the bull narrative I'll be exploring.
Or, on the other hand, are these actions just a cover? Are they mechanisms for, systematic shareholder dilution, all driven by a desperate need for what looks like toxic financing? That's the structural bear narrative. I'll be arguing for the mechanics of that dilution.
And I'll present the case that these were, frankly, essential moves for survival and ultimately value acquisition. So let's just look at the context here. The legacy Cool Japan narrative was dead on arrival. The stock had plummeted over 95% from its $4.30 IPO price. So management needed a complete license to pivot, which they got with the rebrand to Harrison Global. My core argument is that these actions are actually strategically coherent. They're moving BLMZ from, what you'd call a low-multiple, unprofitable anime company to a high-multiple crypto proxy. This is designed explicitly to attract speculative and algorithmic capital, money that trades on volatility, not traditional cash flow. And crucially, that 1-for-10 reverse split in November, that was a necessary Hail Mary maneuver. It was all about curing the NASDAQ $1 minimum bid deficiency. Avoiding delisting was job number one. Then you have the $10 million share repurchase authorization. Now, it's conditioned on trading below $1, but it acts as a price floor guarantee. It sends a message. So, I see why you think that, but let me give you a different perspective. These aggressive technical actions are focused on creating the conditions to survive and harness that massive 48.69% short interest for a potential squeeze.
That narrative is definitely compelling, I'll give you that, especially for investors looking for a high volatility bet. But we have to look past the headlines at the financial plumbing here. I believe the pivot itself is strategically incoherent. It's a spaghetti-at-the-wall approach. You've got metabolic drug development with BioTree, event planning with Idealize, the legacy audio business, and now Bitcoin. If the goal was value creation, they'd be focusing, not diversifying into unrelated fields. The true driver isn't growth, it's the immediate, high-velocity need for cash, and that cash is coming from toxic financing. I'm sorry, but I just don't buy that the pivot is primarily about a better valuation. Let me tell you why. The Bitcoin purchase agreement is directly linked to White Line Capital, and this is a financer with a well-documented history of what we call death spiral financing structures, seen in tickers like OSR Holdings and Actelis. The core paradox is this. How does a loss-making microcap company suddenly have the money to buy Bitcoin? The answer is, by systematically selling equity to White Lion at a deep discount, usually 10 to 20% below the VWAP, the volume-weighted average price. White Lion then just liquidates those shares on the open market. The Bitcoin treasury strategy is the justification for issuing all this new stock. It's funded entirely by diluting legacy shareholders. So the company is really just a pass-through entity, converting shareholder equity into cash for its financiers.
Okay, that link to the financier brings us right to the market microstructure. And the most jaw-dropping figure here, that nearly 49% short interest. If we accept your premise that this is a dilution machine, how do you explain that number? Isn't that a massive pressure cooker waiting to blow?
It's a huge figure, but what matters is the character of the shorting. This is overwhelmingly what's known as arbitrage shorting, not your typical speculative short. See, White Lion has a key structural advantage. They know for a fact they are going to receive deeply discounted shares from BLMZ next week. So what do? They short the stock today at the higher market price. Let's say it's $1, locking in a guaranteed profit. Then, when the new shares are issued to them, they just use those to cover their short position. And here's the critical part. Because the shares used to cover were issued by the company itself, that covering buying pressure never actually hits the public market. It's all an internal inventory shuffle. It completely neutralizes the short squeeze potential.
That's an interesting point, though I would frame it differently. I mean, yes, arbitrage shorting is a known mechanical risk in these structures, but it doesn't eliminate the squeeze potential entirely, especially not at this extreme level. Arbitrage shorting is systematic, I get that, but the retail market is purely speculative, and you have to acknowledge management is actively courting retail investors. The XRP X Club partnership, all the Web3 buzzwords, that's not for institutions. If a big momentum-driven retail buying frenzy suddenly runs the stock up to, say, $1.50 or $2, it forces other institutional shorts, the ones who aren't White Lion, to cover on the open market. That sudden spike can overwhelm the pre-planned arbitrage. And again, that $10 million buyback authorization, it reinforces the narrative that management will defend the floor. It's a psychological barrier.
The off-exchange short volume ratio, according to Fintel, is consistently between 26 and 29%. That institutional selling happening off the public exchange, that's White Lion and others managing their inventory of discounted shares. They are continuously unloading stock without crashing the visible price. It creates an invisible ceiling that just stalls out any retail-driven rally. The liquidity that retail brings in is immediately absorbed by that institutional selling. A sustainable rally becomes, well, mathematically almost impossible.
Okay, let's pivot to the actions management can control. That $10 million buyback authorization, it's a powerful signal, especially since it exceeds the company's historical market cap. I'd argue this shows a real commitment to defending that $1 NASDAQ listing line. And defending that line is everything right now. They're in a one-strike position after the reverse split. If they drop below $1 again, they could face immediate delisting. So this authorization, it demonstrates a belief in the pivot and in the strategic importance of staying on NASDAQ. That's the platform for any long-term recovery.
I'm not convinced by that line of reasoning because we have to view these conditional statements with extreme skepticism. The buyback is likely unfunded. I mean, a $10 million program for a company with this cash burn? It's financially nonsensical without a major clean capital raise, which we haven't seen. The authorization isn't an obligation. It's just a PR tool to, trap short sellers or induce retail buying. And let's connect this back to the Bitcoin strategy you mentioned. The company acquired the CoinBridge stake, paid with $1.5 million in Bitcoin. You said that proves the treasury is active. But where did that Bitcoin come from? It came from the cash they got by issuing discounted equity to White Lion. They're liquidating shareholder equity to buy crypto, which they then point to as proof they deserve a crypto multiple. It's a shell game. The asset is funded by devaluing the equity itself.
That's a harsh assessment, but it doesn't nullify the strategic gain. The company is actively trying to get that higher crypto multiple, which inflates the valuation relative to a legacy anime firm. If they successfully transition their classification in the market's mind, they create value. And the fact that co-CEO Roshan Nakade, whose background is in accounting and law, is prioritizing this, it proves the focus is on achieving a sustainable listing and a higher valuation. Survival in this environment often demands this kind of high-risk financing.
Survival at the cost of shareholder equity is not value creation, it's financial extraction. And we also have to consider these structural disadvantages, like their foreign private issuer or FPI status. Operating as an FPI, incorporated in the Caymans, creates massive information asymmetry. They file less rigorous reports, like the 20F and 6K. This allows for long dark periods where we have no idea what their true cash burn is or how fast the dilution is happening. This FPI structure also offers far fewer protections for minority shareholders compared to, say, standard U.S. corporate law.
That's a compelling argument on shareholder protection. But have you considered that management's focus must be on NASDAQ compliance right now? The FPI status, while risky, gives them the flexibility they need. The immediate existential risk is delisting. The reverse split reset the clock, but as we said, they're in a one-strike situation. All of their actions, The compliance maneuvering, the timing of announcements, the conditional buyback, it all shows a laser focus on maintaining that listing at any cost. You can't get a high crypto multiple if you're trading on the OTC markets.
True. The NASDAQ listing is required for the dilution machine to even function properly. It provides the liquidity for White Lion to offload shares. But the reality is that while the narrative, Bitcoin, Web3, is compelling for retail, the forensic evidence points to systematic value erosion. The involvement of White Lion, the arbitrage shorting, the high dark pool volume, it all indicates the equity is being used as a source of institutional liquidity, converting shareholder capital into cash for financiers.
And I would argue, conversely, that the company executed drastic, necessary moves to survive a catastrophic failure. They maintained their NASDAQ listing, and they established a new, higher multiple business classification. That huge short interest, combined with management's price defense via the buyback, skepticism aside, creates the exact technical volatility needed for a potential rally, fueled by the market's speculative appetite for anything crypto-related. The narrative shift is a survival mechanism.
And the problem is the mechanics of that survival are structurally bearish for existing shareholders.
But the necessity of survival can sometimes override structural reality through sheer speculative fervor.
We'll have to see which force ultimately wins out.
We've laid out the two opposing interpretations of BLMZ's aggressive financial maneuvers. Whether this corporate metamorphosis yields value or just ends in structural failure, well, that remains to be seen. It will be determined by the balance between these institutional mechanics and raw retail sentiment, a process that listeners will have to keep exploring in the company's filings.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.